Hi, this is Ed Jorgensen, and as June closes, I'd like to take a look with you at where investments stand today. As you know, we had quite a Trump bump after the election, and then a marvelous tax cut rally in December and early January, then a mini panic in February, and there's a back and forth since the mini panic. The market has not collapsed, but has not recovered the exuberant highs of November and December, January of last year and the beginning of this year. But we should be grateful. If you look outside the United States, blue chip stocks, Europe, Australia, the Far East, are well below their peaks before the 2008 world financial crash. These international stocks had a spectacular rally from 2003 to 2008. But boy, did they give it back. And the recovery that we've had in the United States has really been unique. Our markets today are being influenced, despite all the craziness in the news, by two key factors. The first is oil. Oil is always underestimated by analysts as just how crucial it is to the daily budget of families and the health of the American economy. If you look at 2007, 2008, the years of the housing crash that became the financial crash, what triggered the housing crash? We'd had excessive family debt for years, and housing prices had been rising for years. What brought that boom down was the spike in oil prices from $60 a barrel in 07 to over 120 only a year later. Rising fuel, heating, energy costs made the debt unbearable and led to the crash. Conversely, 2015-16, the temporary decline in oil prices as OPEC tried to regain control of the market was a tremendous impetus for our recovery and helped that stock market rally that we enjoyed in the last few years, helped keep it going. But right now, today, if you look at oil regaining, as it was bound to regain, $70 and soon $80 a barrel. That same pressure on the economy, on budgets, on finances, and on our investment markets is in the process of recurring. It's a red flag. And the second red flag is rising interest rates. Almost from the day Trump was elected, the Federal Reserve embarked on a policy of raising interest costs. Interest rates had been negligible throughout the entire post-crash era, the entire Obama era. But now short-term interest rates are over 2%. At first, there was no effect on long-term corporate financing and bond rates. But now in 2018, you've begun to see a reaction with both corporate and government bond rates moving up. Interest rates have supported the recovering market since the financial crash. And now, for the first time in 10 years, instead of an impetus, they are a headwind. Janet Yellen, Obama's chairman of the Federal Reserve, was a very, very savvy economist. She understood the interplay of interest costs and family finances. She was a labor economist from the tradition in the Democratic Party. And she did Obama no end of good by keeping interest rates low. Mr. Trump has replaced Mrs. Yellen with a classic hard money Republican economist, apparently determined to continue raising interest rates, and I understand that they are abnormally low, and in a sense the system needs and must in due course return to a normal interest rates, because money is not free. But that transition is not going to be easy. Now, look, on the one hand, we can enjoy it. There's the current yield on a particular Schwab money fund that was zero only 2 years ago. And as I speak, it just hit 1.86%. That's not glorious, but it's the first time that low-risk money, stable price money, had any return at all. That's great. I just add, when security comes with a return, investors are more likely to put a little security in their portfolios and take a little risk out of their portfolios. And one of the reasons that the market seems to be in a back and forth with some good weeks and some bad weeks here is that investors are now debating the returns available from business risks compared to the returns available from a safe money fund. And it's not as easy a call as it was 3 years ago. Well, all that means that Mr. Trump may regret that he picked a Republican economist, even if it was the, as it were, right thing to do. We have a long history of public stock markets, and small increases in interest rates come and go, but steady rising rates are the food of the bear. And as I say here, Mr. Trump, perhaps unwittingly, may have invited the bear to his party. I will never forget the great Arthur F. Burns, the most famous Republican economist of years when I was a kid. The first time OPEC raised oil prices, the conservative Mr. Burns was absolutely certain he knew what to do. He was going to counter the inflation of high oil prices by raising interest rates. He was going to use the old-fashioned medicine. And he did. And in the 2 years that followed, he destroyed the stock market. The Dow was over 1,000 at the beginning of 1973. And by the time Mr. Burns had implemented his tight money, the Dow had fallen over 40%, and many of the great growth stocks, the famous Nifty 50, the high techies of their day, fell 60% in 2 years. High interest rates, even if theoretically you think they have a reason, they destroy stock prices. So let the warning flags fly. In this mix, I am a bit taken aback to see that margin debt here in late spring is actually higher than it was before the February mini panic. So speculators, having seen a relatively modest decline in prices, have redoubled their bets on a rising market. And I have to tell you, that mix of speculators increasing their borrowing to buy stocks at a time when the cost of borrowing is rising is historically a really nasty mix. It's a mix that, in the market timing models that I wrote 40 years ago, based on historical precedent, it's a mix that spells, that issues what they used to call in the 1970s sell signals. I mean, nobody really 100% buys or 100% sells, so the word sell signal is a little extreme, but it's a caution signal. So this market faces headwinds. And why hasn't it fallen even more? Well, it's being kept up by what the market expected in November and December, the torrent of cash coming in from overseas based on Mr. Trump's changes to business taxation. And it is a torrent. Every major international company is bringing back hundreds of millions to billions of dollars, and that is cash coming into the U.S., including coming into U.S. stock markets. And it has it pumped the market up earlier in the year, and it is helping keep it up now. So here we are. And I suppose I've said now for decades, markets always have pluses and minuses, and we strike a balance. And as I talk here, I don't think I need to tell you that all these wonderful charts of the past are exciting, but they don't predict. They don't predict what will happen this summer, the fall, the election next year. They can warn you of risks and opportunities, but nothing is a guarantee. But we've done this a long time, and you know that. So how do I see it now? Stock markets, investment markets in the U.S. have come a long way, not overseas, as you saw. It's been a misery overseas, where investors collected stock dividends, but price appreciation, no. Both in the U.S. and overseas, there is, as there has been for years, way too much debt. The debt in Europe is ridiculous. The structure of the European Union is unsustainable. Long before the migrants began pouring in, the relationship between the economy of Germany and the South was completely unsustainable, really. Based on the European Central Bank essentially issuing debt out of its black rabbit hat and propping up the economies of the South because they weren't allowed to devalue. Not a sustainable situation. So we have huge risks from debt. Debt is a risk. It allows you to buy a lot and do a lot, but you know what they say, debt is for danger. Always true. That mix I showed you of a lot of debt in the market, a lot of margin debt, the cost of margin debt, interest rates rising, that is a negative in the technical models that I have. So our stock market timing models have flashed any number of nervous signals ranging from be careful to sell everything in the past 2 months. But that goes back and forth. And as I said, the pro-business climate in Washington is keeping the market up. And while interest rates are high, it's a bit extreme to call a money fund yield of 1.86% as a terminal threat to the stock market. it's a headwind, but it's not a case of arsenic. But it is a headwind. So there we are, a market with tremendous momentum. In the developed world, the United States is, both in its business and in its markets, far and away the most dynamic and improving economy. But for the first time, we have risks of higher oil prices and higher interest rates for the first time in 10 years. So we have a balance now. And it's a balance that we'll be striking in our portfolios. I look forward to catching up with you in person over the summer. Have a great July 4th, and speak to you soon. Bye-bye.